Good afternoon, everyone. Thank you so much for joining us on this sunny Thursday afternoon. My name is Aurelia Casatli. I am a senior private client manager at CAF, and today's webinar on impact investing marks the second in this year's philanthropy webinar series. So for those of you who haven't perhaps joined one of these webinars before, the aim of these sessions is really to help our private clients as well as other interested stakeholders in the third sector learn a little bit more and be inspired by really kind of interesting or exciting issues and cause areas in a little more depth. And so I really hope that you find today's session useful and that it helps you to develop your thinking in this area. But if you do have any feedback or ideas on how we can make these things better, please don't hesitate to get in touch with me after the session. And also, immediately after this webinar finishes, there'll be a sort of survey that pops up on your screen. And if you could just take a minute or two to finish that and complete it, it would be very much appreciated. So we'll also have time for you throughout the session to submit questions to our panel, who I'm going to introduce you to in a minute, just via the sort of software function that you see on your screen right now. You can just kind of submit questions there as they come to you throughout the session, and we'll take them all together at the end, and I will put them to our panel. But now, without further ado, let's really turn to the kind of interesting subject for today, which is what is impact investing? So it seems obviously like a very simple, straightforward question, but with quite a few kind of complicated answers and nuances to it. I think it would be helpful if we just set some context for the significance of this session today. With the figure that the Global Impact Investing Network estimated last year at the end of 2018 that the worldwide market for impact investing was $500 billion. And they estimate that this will grow to $1 trillion over the next decade. So practically what this means is this is a lot of money with which we could have a positive impact, or potentially no impact at all, or even potentially some harm if we're not using that money well, and if we're not sort of developing consensus or more understanding around what impact investing is and when it can be effectively used. And so that's sort of the goal that we've gathered everyone here today to discuss and to try and unpick some of these issues, so that hopefully yourselves, as you know, after today, when you're considering impact investments, you know, for yourself or potentially for your organization, you might find some of these issues that we discussed today useful and helpful in that. So I'm going to introduce you to our speakers. So first of all, we have Alice Millist from the European Venture Philanthropy Association. Alice actually started her career in finance before moving over to the impact side of things at Social Finance. She also does a lot of freelance consulting and kind of advisory on social impact, in addition to her current responsibilities at EVPA. Alice is going to contextualize the world of impact investing for us and also define and explain a little bit the work that EVPA is doing in the sector. Alice will be followed by Hauke, who is the founder of Letsfundorg, which is a platform that identifies highly impactful donation opportunities for people to support. But he has also spoken and written a lot about investing for impact and the pros and cons of that and how to do it well. Specifically, he co-authored a very kind of clear and robust paper that makes very tangible recommendations for potential impact investors and some of the methodologies and things that they can think about when approaching an impact investment. And we will be sharing indeed that report and sort of other resources mentioned throughout this session with everyone registered at the end. So you will be able to read that in depth if you're interested. Following Hauke, we'll have our very own Joanne Wedderspoon, who is the Funder Relations Manager at CAF. And if you are a private client of ours who's invested in Venturesome, then you may already know her. And Joanne is really going to kind of talk through Venturesome's approach, the sorts of capital that they give, the kind of support they give their portfolio companies, and in what circumstances that is really maybe more beneficial than a grant to those kinds of organizations. And so it's really going to be good to get more specific ideas and examples of a kind of impact investing from Joanne. And last but not least, we're going to hear from Edmund Dunstan, who is a client of mine, and I'm so happy that he could join us. The slide wrongly says he's been a client since 2004. In fact, it seems he's been with us since the 1990s. So he really has been with CAF for a very, very long time. He's also dabbled in some impact investment himself, and this is an area he finds very interesting. And so he's really going to share some of the considerations and things that he thinks about and that he recommends other potential impact investors think about, including the trade-offs and kind of other sort of important factors that he thinks it will be useful for everyone to consider. And so just before we kind of hear from Alice, in order that we can get a sense of basically your kind of awareness in the audience of impact investing, whether you've done it before, if I could ask you just to take a quick second to click on your screen, whichever sort of option, if you will, applies best for you in thinking about how familiar you are with impact investing. Is it working? Just a few more seconds while some answers come in. So it seems like most people are familiar to some extent. So 19 say they're very moderately as well, somewhat 31 people. So basically, for those of our speakers today, we're really, we're dealing with a somewhat experienced audience who are probably familiar with a lot of the things that you're going to be addressing. So that's good. But if you could also let us know if you've actually ever made an impact investment, if you think you have, if you don't know, if you haven't, but you're interested. And then at the end, some of the questions that we kind of put to you when the webinar is finished, this will sort of get a sense of whether you really learned something today and whether or not we kind of potentially inspired you to think about this differently in the future. And it seems that most of you have not made an impact investment before. So that's good. We can see if we managed to change anyone's mind today. Perfect. Great. Well, Alice, why don't we start with you just kind of talking about the world of impact investing at a higher level. Thanks.
Oh, hello, I'm Alice, and my microphone wasn't on, but it is now. I am the UK and Ireland representative for the European Venture Philanthropy Association. We are a membership body, and ultimately, simplistically, I suppose, our activities are intended to try and encourage more money to have more impact through either grant making or social investment activity. So I thought I would start just by using a very widely recognized definition of impact investing. Aurelia already mentioned actually the Global Impact Investing Network, or more informally known as the GIN. And their definition of impact investing is that impact investments are investments made with the intention to generate positive, measurable social and environmental impact alongside a financial return. And I suppose the one thing that I wanted to draw everyone's attention to with this particular definition is the intention. That will come up, at least for me, in a few of my slides. And it really kind of resonates with a lot of the impact investing activity, that it's about the motivations of the investor, the motivations of the provider of capital, as to whether we could consider that they are truly impact investing or not. EVPA have a lot of, we develop a lot of research that we hope is useful to people who are trying to explore impact investing and also different forms of grant making. And we've developed our own distinction really within the impact investing ecosystem of investors for impact and investors with impact. So really that comes back to that intention point that I'm talking about earlier. And I think the easiest way to kind of draw this out a little bit is to talk about the organizations that we see either investors for impact funding or investors with impact funding. So investors for impact would really prioritize the impact that their money is having above all other considerations. So whether they get any of their money back or how much of their money they get back and how much of a return they get on that money is really a secondary consideration. The impact that they're achieving with that cash is their number one focus. So typically you would consider a grant-making organization or any kind of donation-led activity as being investing for impact. You're not really expecting any financial return, or if you are, it's not your main motivation. So at the left-hand end of our spectrum, you would see grant-making activity into SPOs, which stands for social purpose organizations, that are delivering services into a market that will never be financially sufficient and sustainable from a commercial perspective. At the right-hand end of the spectrum, we're looking at investors with impact. So those are investors who have access typically to quite a large pool of capital, but need to guarantee a level of financial return alongside the positive impact that they're looking for. So I'm thinking here really about pension funds, probably sovereign wealth funds, where they do have a floor in terms of the financial return that they need to deliver to their investors with their cash. And so typically, those investors might be looking at for-profit businesses that also have a social or an environmental impact, but can still yield a commercial rate of return. I think one other crucial definition that I'd like to draw between these two investors is that we tend to see investors for impact as those who are able to take risks that other actors are unable to take. So typically we might see that the government would be slightly risk averse in terms of commissioning or funding more innovative services that are intended to have social impact, and equally mainstream investors, because they're looking for that commercial rate of return, are probably unlikely to be able to fund certain forms of social purpose organisation. So really the investors for impact should prioritise using their capital to back organisations and projects that can't access kind of public money and mainstream investment. The next slide is taken from an EVPA report that we can circulate later called Financing for Social Impact, and is really intended to be a decision tree that would help a provider of capital decide whether they should be using grant money or social investment, or perhaps something that looks like a mixture of the two. Ultimately, it really comes down to the business model of the social purpose organisation and the extent to which the market they're operating in is, or maybe in the future, something that is commercially viable and therefore would yield sufficient surplus to repay some of the capital that has been invested into that project or that organisation. The slides, I think, have already been circulated or will be later, so I won't go through all of this in detail, but that's a bit of an overview as to some guidance that EVPA gives about how to think about what sort of capital might be most appropriate for what situation. And then finally, I did just want to talk about a recent kind of concern that's popped up in the sector. As Aurelia mentioned, there's a huge amount of money that is being called impact investing, and almost every mainstream investor these days has raised an impact fund of some shape or form. The concern is that there might be a lot of what's called impact washing within this activity. So a lot of funds that are impact in name only and really lack the depth and rigor and transparency that is required to truly prove your impact. For example, I've seen quite a lot of funds that are just using the Sustainable Development Goals, the SDGs, as sort of boxes that they can tick to prove that they're having impact, and that's not really a robust way of measuring your impact. I suppose one thing to just mention here is that compared to mainstream investing, it's actually very hard to measure your impact. You're not just looking at revenue growth or profit margins or market share, which can be quite black and white. And so the ability of organisations and funds to actually demonstrate their impact is quite opaque, which is why it can be quite difficult to actually distinguish between good impact funds and less kind of rigorous impact funds. The World Bank and the GIN have introduced some principles and standards to try to mitigate the risks of impact washing, and there's a few other kind of certifications out there, like the B Corp certification for businesses, that tries to give you some guidance on which organisations actually have rigorously looked at their supply chains, the way they treat their customers, the way they treat their staff, etc. But if you are thinking about dipping your toe into impact investing, just be aware that just because it's called an impact fund, it may not truly be that impactful.
Thank you so much, Alice, for that very helpful start. I think that was really quite clear and useful. I actually have a bit of a question on sort of this last slide here, actually, where you say that impact investments need to try to look at the whole impact cradle to grave. Could you elaborate on that a little more? What does that mean and what is it not?
Yeah, so I suppose a really simple example of this is we all were encouraged to use these canvas bags whenever we do our shopping. But in fact, it turns out that creating one of those canvas bags has a much more significant carbon footprint than were we to use the equivalent of thousands of plastic bags in the place of that one canvas bag. So I think the challenge is that it would be very easy to say, this social purpose organization has helped this homeless person to secure a place to live and to secure some employment, but we haven't truly looked at whether they're also treating their staff well and whether actually the use of funds has been the most effective use of funds. So it's just a little bit more complicated than looking too simplistically at impact.
Great, thank you. And I think actually that leads us very well onto Hauke, particularly your point actually, Alice, about the most effective use of funds. And Hauke is going to talk about, as I mentioned, sort of a report that he co-published and also really, I think, challenge a little bit the notions that we all hold of impact investing.
Thank you. Yeah, so I'm the co-founder of Letsfundorg, and we do independent, in-depth research into policy solutions, and then we crowdfund for the most effective ones. So we focus on non-profit solutions, just to disclose where I'm coming from. So, for instance, we just started a crowdfunding campaign for climate policy, and Bill Gates actually just recently called the coverage of our research a must-read, so you can check that out on our website. Can we go to the next slide? We also publish theoretical papers. One that I'll discuss now was published recently in collaboration with John Halstead at Founders Pledge, but all opinions that I'll express now and errors are mine, and of course this should not be construed as financial advice. The title actually gives away what my main advice is about impact investing. As a rule, don't do it. So I'm glad that the survey showed that many people have not committed like a fatal error here. But I'm not ruling out that impact investing can, in some cases, be socially impactful if done carefully. But nevertheless, so my 10-second advice is, if you want to maximize social impact and also have a financial return, then I would suggest to do that separately. Invest for profit, put your money into a Vanguard ETF, which will outperform lots of active management, and then donate as much as you can stomach of those returns to nonprofits recommended by, say, the effective altruism community. And I actually do believe that if you do this, you will do much better than most impact investors, actually. And why is that? Can we go to the next slide? So in the report, we do have 6 key messages for people who are hell-bent on doing impact investing. So the first message is that finding an impactful company is hard. Not only is it hard to find a company that generates a profit, but now we also need to find a company that, or a social enterprise that turns a profit. And so it has to solve 2 very difficult optimization problems here. And as a general principle, multi-objective optimization is much harder than single objective optimization. Yeah, and the second point, the second key message is it is really hard to have additionality in large public stock markets. So if you divest from stocks, that's the basic idea, then there will be socially neutral investors that will come up and swoop in, buy up the now underpriced stock. So this is pretty much just based on the efficient capital market hypothesis. And that's why we generally do not recommend doing socially responsible investing, sometimes it's called, in these large, very liquid, efficient markets. And yeah, some people actually do claim, talking about impact washing, that you get even above market rate returns. And I find that just really hard to believe that adding constraints to your portfolio choice will lead to higher returns. And there was actually a survey recently by IGM Booth with top economists who seem to agree that this is the case. The third point is that there is a scope for additionality and true counterfactual social impact in VC and also in angel investing. But even though there are perhaps more market inefficiencies than on public stock markets, it is difficult to find and exploit these. So the fourth point is that there are trade-offs between financial returns and social impact, and that is sometimes underplayed, I feel. So if you want to have market rate returns, then that means that you just displace socially neutral investors who are just chasing the money and who will come in if there are market rate returns to be had. If you are an impact investor and you accept these lower returns for additionality, then that means that you're giving up some money that you could have made by just investing for profit, and that could be invested or donated to effective charities. Fifth point is that your investment might also displace another impact investor. So this is just like seeing someone doing CPR on someone, pushing them out of the way and doing CPR yourself. This is quite counterintuitive because in the for-profit world, obviously, that's what you want and that's fine. If you make a profit and someone else doesn't, that is just the name of the game. But it's really fundamental when it comes to looking at social impact to look at this. And then the sixth point is that just like in the charitable world, impact investing might have some benefits that are special. So for instance, you can do shareholder advocacy, but again, I find that this is not a free lunch and the benefits are often overplayed. Can we go to the next slide? So yeah, just to sum up, if you want to impact invest, I think it might be a good option for people who already work on an important problem that is neglected by other investors. If you already do VC or angel investment and you can piggyback on your existing expertise and have like a low marginal cost of research, that might be good. And then lastly, this is maybe like the message that needs to get out more, that you need to accept financial sacrifice. There is this allure of the double bottom line, that you can have direct social impact and make a market rate return. But it seems to me at least that there's no free lunch. So yeah.
Great, thank you, Hauke. I did mention that it would be a little bit more of a different perspective to everyone in the audience. I'd actually like to do two things right now. First of all, for anyone in the audience who has questions about anything that has come up so far, don't forget to sort of submit those to us via the chat box and we will pick them up on our end. But also, before turning to Joanne, Hauke, I think it could be quite interesting for the audience if we dug in a little bit to more what you were talking about in your previous slide, which is this question of additionality of the investment. And you're talking about socially neutral investors versus impact investors and sort of one displacing the other, or at the very least, if you are getting market returns, you'll have a socially neutral investor come in. Can you maybe explain that a little bit more for people who aren't as familiar with that concept? And could you also talk about in which ways that does not apply in the philanthropic sector? So one donor displacing another donor with a donation to a charity.
Yeah, so this is pretty much just based on the efficient capital markets hypothesis, which essentially says that there are no easy to be made profits because lots of people are already investing and looking for market rate returns, the highest return possible. So lots of banks and so on. And so yeah, there's this old adage in economics of like two economists walking in a city and they see $100 bill on the sidewalk and one says to the other, there can't be $100 bill because somebody else would have already picked it up. So that means that in the stock market, if you see an investment opportunity, you're most likely that will generate like outsized financial returns. You're most likely to be wrong, and so that means that if you could really consistently generate a risk-adjusted market rate return over the long time average by investing in socially beneficial companies, then people who don't care about the environment or modern slavery or what you have at all, they would come in and invest as well because they're just looking at profits. That's why it's so hard.
And what about the point on the philanthropic sector? So that you're saying it doesn't apply because we're not talking about the application of sort of efficient markets.
Yeah, exactly. So in the philanthropic sector, you're giving money to nonprofits, and your money is pretty much it does not generate a return at all for yourself. So that means that there are no socially neutral investors or even that will invest, and so then there's much more of a market inefficiency and like a much bigger philanthropic market that is very inefficient, that needs money, and where you can have like an outsized social impact, because very rarely you're pushing someone off the charitable investors table because they're just not very crowded.
There's not enough in the first place, basically.
Exactly, yeah.
I see. Okay. Well, Joanne, this is perhaps a good opportunity to kind of learn a bit more what Venturesome does.
Yeah. So, hello, everybody. CAF Venturesome is the social investment team within CAF. And social investment is one type of impact investing, but it's the use of money to achieve a social return above the financial return. By social return, we mean intentionally supporting social impact. By financial, we mean return of at least most of the capital that's invested. And for funders, the easiest way to think about this is as a recycled grant, and I'll go into that in more detail in a minute. But CAF Venturesome uses CAF's clients' philanthropic capital to offer social enterprises and charities the affordable, repayable finance they need to grow, and that's loan finance. Next slide, please. So this spectrum of impact is actually the other way round to Alice's slide. So on the left, you have traditional investing for a financial return, and on the right, you have grant making. Social investment sits towards the right in the impact-driven side. So we're impact first rather than finance first, and they're the products that we offer to social organisations. Thank you. So how it actually works, and I'm just going to use the figure of £100,000 as illustration only, but what happens is philanthropy can make a loan, a 6-year loan to CAF Venturesome instead of making a one-off donation. If you make a one-off donation to an organisation, you are supporting one project or a year's worth of work delivery, and you usually only receive a report at the end of the project or at the end of the year, and that money is gone. It's been used carefully, but it's gone. If you make a social investment of 100,000 with CAF Venturesome, the money goes into our large fund, and it's distributed in affordable, flexible loans to social enterprises and charities over and over again. So as the organisation repays it to us, we can lend it out to other organisations. And our funders can choose several up to 9 different causes that they want to support, and you receive 6 monthly updates, so you can see exactly where every penny your impact is being used, and you get to know the organisations as well. So thank you. So why use philanthropic capital? We've talked about that you might as well just invest your money and then give it the profits to good causes, but we believe it's actually a better way is to use it with social investment, as that philanthropic capital has already been set aside for charitable giving. it can be used to support organisations that have a high social impact, but often have a financial risk. So most social organisations that don't have security to secure for a high street bank lending struggle to get finance from traditional borrowers. Therefore, they come to us because we can lend to them, and we really get to know the organisation. We carry out extensive due diligence on them. We get to know their management and their trustees. And only after we're comfortable that they can afford to pay back the loan will we put it to our independent investment committee, who will then approve it. So although we do make social investments to organisations that are seen as being a higher risk, we wouldn't ever be careless with your philanthropic money. We're extremely careful to ensure that we only lend to the organisations that we believe have the ability to repay the loans. And as social investors, the risk is diversified across a portfolio because you lend a portion of your money into each of our loans. So social organisations can benefit from social investment because it's a way of making them actually really think about how to make their organisation stronger so that they can repay the loan, and they're better able to deliver their impact rather than just accepting a grant to deliver one project. Venturesome has been around since 2002. We've got 17 years of experience of making over 600 social investments to about 450 social organisations, totalling more than £50 million. And we've been funded by 130 of CAF's generous clients. Just one quick example of the organisations we've supported. Change Please, they're actually getting quite a lot of press at the moment, and this morning it was announced that they're now going to supply the coffee on Virgin Airlines. They already supply Virgin Trains, and they have 10 coffee carts around London. I don't know if you've seen them. There's one just outside London Bridge Station. In 2017, we lent them £50,000 in an unsecured loan to buy the coffee carts. And they are run by people who have been homeless, have given them work experience and able to earn their own money. So they have just gone from strength to strength since they borrowed the money from us in 2017. And Chamal, their founder, has been recognised as the UK Social Entrepreneur of the Year in 2019. So their recent growth has been enormous, and that is thanks to social investment.
Great, thank you, Joanne. I think it would maybe be interesting as well to hear a bit more. You said that the kind of financing that Venturesome gives is loans, but you're giving it to smaller organizations. It's all in very sort of illiquid markets, going back to Hauke's point. None of it is publicly listed. But why is it in particular that for these organizations or for the projects that they're coming to you for funding for, why is it that a loan is better than a donation? So you just give them the entire money, you don't ask for them to pay it back.
In some cases, a donation is better. We're not always saying that social investment is always the better, but it makes them concentrate their financial governance rigors. Just makes them concentrate more, deliver their businesses, turn their models. So it just gives a lot more structure to a business, we believe.
So you find that it incentivizes them to be better run, essentially,
yes,
and more efficient in their use of resources.
Yeah.
Okay.
And we will always support them to help them improve their procedures.
Yeah.
Sorry.
Well, that actually then leads on to a second question that I had for you, which is that sort of, and I'd be interested to know, Alice, potentially later on, if you have a view on this as well, but there's a general feeling among the kind of broader social investment or impact investment sector that sometimes that sector and these funds offer capital at higher rates of return than maybe a high street lender would. Mm-hmm. So I suppose the first question is that actually true, or is it something that just gets bandied about? And then second of all, if it is true, what is it that social investment funds or impact investment funds might be giving their portfolio companies that a regular lender would not?
Well, the fact that they can borrow the money, because the social organisations that come to us for funding can't get traditional high street borrowing, and they would only come to us in those circumstances. We would always suggest that they go to the high street if they can, or to CAF Bank even. But we lend typically under 500,000, about 150,000 is our average. And it is at a higher rate than the high street banks, but it's because we're taking the loans at higher risk, no security.
Perfect. Okay. So I suppose Venturesome has a slightly different approach from many of the other players out there. And Alice, I know that we've talked about this in the past as well. What do you see in this?
Yeah, I mean, I think there's also a really interesting point here around why would you use social investment rather than grant? I think in addition to what we talked about with changing the behavior of the organization, if you have used your social investment to catalyze revenue generating activity within a business, so if we look at Change Please as an example, once they have repaid their £50,000 loan, they are generating income that can sustain their activity indefinitely. Whereas a grant will fund your operations for a year or 2 or 3, and then you need to raise another grant. And the amount of operational activity that goes into raising and reporting on grants is enormous. Most of the third sector organisations that I've worked with will have at least one full-time fundraiser, sometimes 2 or 3, just to keep the cash coming in the door. If you can support that organisation to move to a point where they have a mixed business model, for example, where some of their operating costs are being covered by revenue that they are generating themselves, and that revenue is being generated in a way that is what I would call mission aligned. So the activity that generates that revenue is in fact delivering impact anyway, then it's a win-win. It's a really exciting opportunity for that organisation.
Perfect. Thank you. Those are some very, very interesting insights. I think that our audience are going to, it adds a slightly different perspective, let's say, to what we were just talking about before. So just before we move on to our last and final speaker, Edmund, I just want to remind the audience that if you do have any questions, keep them coming in and we will come to them very shortly at the end. Edmund, over to you.
Good afternoon. I suppose I come to this as a point of view of the sort of small to medium presence in this sector, and I'm not qualified, authorised or purporting to offer financial advice, and you see I have some competing interests. So, what are your impact objectives? What or whom do you want to support? Is this specific causes? Is it a group of causes like the environment or animal welfare or something? Is it charitable causes as a whole? Or is it beneficial economic or indeed other sort of social and community activity? There's a wide spectrum. Next, please. And the other thing you need to clarify is what sort of return are you looking for? Are you, sorry, I think my slides have got mixed up. There are some, sorry, the order's got mixed up, I do beg your pardon. If it's your money, it's up to you how you invest it, what sort of risks you're prepared to take, what sort of return you want. If you're investing on behalf of a trust, and to some extent I have been, how does the candidate organisation map onto your trust's objectives and also its strategy? How much risk is acceptable for its capital? What sort of return might it require? And does the potential investment match your trust's objectives? And I'll illustrate this later. So next, please. So what sort of benefit to you are you looking for? Well, there are some things that yield quite a respectable yield, comparable to the open market. There are some things that the yields are realistic, you might say, but they're not. But they may not be competitive. There are some, the yield is significantly less than what you might get in ordinary markets. And by yield, I mean interest rate. I'm excluding things like return, like risk and so on, because we'll come to that later. There are some things which I call sacrificial investments, where you might expect no actual return, no interest or dividend. You might even lose. And the things I've been involved in, none of them have I been able to expect any capital appreciation. So let's look at a few specific examples. There are crowdfunding platforms which you can invest in specific enterprises, like solar energy in Africa, for instance, renewable energy in the UK, broadband in Northern England, for instance, has been in the rural north, has been subject to a crowdfunding on a crowdfunding platform. Community enterprises. These may have good interest rates, very tempting in the current climate, but they are not tradable, they're not liquid, they're potentially risky. I have to admit, as far as the solar energy is concerned, I was a bit unsure I wanted to invest in the Democratic Republic of Congo. Some altruistic organizations have issued shares. These have the same risks and uncertain returns. I mentioned the Ecology Building Society as an example of something that works in a specific area for people who are interested in the ecology and climate change and so on the interface between positive investing, if you like, and the ordinary market. They lend money on climate neutral houses and things like that. What sort of sectors are we talking about? Or rather, sorry, sectors. We've heard about CAF Venturesome, and the trust I'm involved with did invest in CAF Venturesome, but it didn't actually really match the specific objectives of our trust. And so, quite amicably, at the end of the 6-year term, we took the money out and invested in Oika Credit, which is a Dutch Christian organization that funds various development projects and so on in the third world, which matched our objectives more precisely. The charity bank offers a fairly competitive rate on savings and lends to UK charities. Shared Interests, as an example, is a friendly society in Newcastle that lends to fair trade producer groups and buyers. Sometimes they pay a very nominal rate of interest, well, comparable to a building society instant access account, comparable, sometimes not. And finally, Triodos Bank, which I mentioned as an example, it lends to a variety of community, environmental and social enterprises and organisations, many of which aren't charitable, that they may well be beneficial in a variety of ways, and again, operates to some extent in the commercial marketplace.
Great, thank you, Edmund. Before we move on to questions, and I can see that quite a few of them have been coming in, I just want to touch, Edmund, a bit more on your personal experience. Is there anything that you have learned from your time as an impact investor so far, things that didn't go out sort of as you would have expected, didn't go to plan, and anything you want to share as a consequence of that?
Well, as an impact investor, I suppose I hadn't really thought of myself as an impact investor.
So you would be in the don't know section had you been answering
I would now say
potentially
that until very recently,
yeah.
I don't think so. I think it's just the only thing I would say is that the boundaries are very fluid, and as previous speakers have emphasised, it's all on a spectrum,
right?
Of both benefit and return.
Right, and I think kind of obviously people have slightly different opinions on it, but certainly a lot of what you just mentioned in terms of the funds on, I think perhaps your second last or last slide there, Venturesome, many other things we're talking about, these are all in illiquid markets. They're all kind of below the radar. They would count more, as Hauke said, in the kind of angel VC space. You know, we're not talking about investing in ESG funds or kind of screening and things like that, which sit on the other end of the spectrum.
Yes, that's right. And but I hadn't really sort of
framed it that way.
They're not tradable,
right?
And
so for you, would it be fair to say that kind of the investment strategy that you've pursued is more because you think it's sort of the right thing to do, and you like the ethos of the way that these organizations function, and you want to support that type of business?
That is precisely that. And so, say I'm prepared to put money into bonds for solar energy in Africa, say,
right,
because that's ecological, and B, developmental. And I accept that there's a higher risk than if I put it in the building society. But on the other hand, there's also a higher rate of return. So it's
It makes sense to you.
It's consistent because it's money that, fortunately, well, if it did go down, if I did lose it, well, I could stand that loss. So that's all right.
Right. Yeah, and I suppose that's another point as well. And I'd be interested to know, Joanne and Alice, what you think of this question of the signal that gets sent by these types of investments too, even if they're not necessarily the most impactful thing, that there is kind of a movement in terms of what you expect from business, or what we expect from businesses. Would you say that's true?
Yes, absolutely. I don't think that anybody is investing their money these days purely for the financial return. They need to look within themselves at what they want to achieve from their investments.
Right.
Yeah, and I actually think this touches on a sort of remark that I wanted to make, reflecting on all of our presentations, because I think on the face of it, it appears that we are in conflict with one another.
Right.
There are some people who are really pro-impact investing and some people who are against impact investing. But I think when we're talking about the efficiency of the markets, for example, I think that the portions of the social investment market that the rest of us have been dabbling in or active in are still inefficient.
Yeah.
We're talking about the areas where the mainstream won't invest. To your point around CAF Venturesome and what they're active in. And also, I think when I talk about the investors for impact and their intention and their priority being around the impact and being willing to lose some or all of their money because actually their focus is on the impact that their money can achieve. I think that's really crucial. And actually, I think when I look at the investors with impact end of the spectrum, if I'm being completely honest, all I'm really saying there is that I would like the mainstream to look at what impact they're having. So, Hauke, I'd be really interested actually to ask whether you feel as though you can stand by that claim around it's better to invest in the mainstream and use your profits and give them away when we don't actually know the full depth of any of the harm that some of those mainstream investments might be having. I think my call to the market is really to say, fine, invest for a commercial rate of return, but I'd like you to be looking at your own social and environmental impact at the same time.
Yeah. So as I said, I think it is the real impact that investing in a completely diversified portfolio and all kinds of publicly traded companies that includes tobacco companies, that includes the fossil fuel industry and so on, is about socially neutral. So if you were to sell your shares of these companies, you would make a little financial sacrifice, which you could give to charities, and B, even if you were to sell them, then other investors who are socially neutral would come in, buy them up, and the stock price would return to the equilibrium state with no adverse impact for these companies at all. There is, of course, some hazard that this sends like a bad message, that this is just bad PR, and like maybe we should. Some people don't want to touch these companies. They just don't want to be associated with them. But I don't think the consequences of your investments are bad. And so I truly do believe that the best strategy is to not divest, because you will make a little bit more money, and then give to very effective charities and nonprofits that are focused and really optimize and really have the single-minded focus on social impact, and they don't have to worry at the same time about like selling things, making a return and so on. So yeah, I do feel quite strongly about this. Yeah.
Okay, and since we'll just keep it on you, Hauke, because I'm going to ask the first question that's come in from the audience, which is sort of, are there certain cause areas within the sphere of impact investing that are much more popular and receiving a lot more investment than others? Why is this? And then for people who sort of want to take some of your remarks really to heart, what would be a better area which is receiving less attention, where likely an impact investment could do more?
So yeah, I do not know like what the split is like in terms of like where most of the impact investing goes. One thing that I feel like I can speak to just based on my climate change expertise is that investing in for-profit companies that are looking to work in clean energy. This is a huge market. The energy market is a $5 trillion a year market, and there's lots of socially neutral capital chasing innovations in clean energy. And so I think one needs to be aware of that there are like many people at big banks trying to invest in like energy innovations because there's just so much money on the table, like 5% of world GDP. So I do believe that the market inefficiencies and the market failure are more when it comes to clean energy innovation and at the government level. And so the crowdfunding campaign that I'm running currently on climate policy, that tries to increase government spending on clean energy R&D, like the very basic kind that is neglected by the market when it comes to long time horizon, very risky investments. So that's one thing I could say about this. Yeah.
Okay. Another question from the audience, which I think is actually very good and touches on something we haven't really covered yet. I feel like Alice and Joanne are best placed to answer. And the question is there a danger that a shift toward impact investing as a model in sort of the broader philanthropic sector will lead to undue pressure on the organization, so investee companies themselves, to produce financial returns potentially to the detriment of beneficiaries? So in a way that isn't beneficial to what that charity or the social organization is trying to achieve?
Yeah, so actually my slide that showed the decision tree earlier would be useful to look to in answer to this question, which ultimately tries to say that there are certain forms of activity or projects or organizations that will always need to be grant funded. And through your conversations with that organization, you will be able to ascertain whether that activity should just be funded through a donation or funded through a grant. However, I do believe that there are some, for example, social enterprise business models out there that operate really well with a repayable financial structure, and in fact can achieve more impact than they would if they were funded through a grant alone. So the answer to the question is it depends. So it depends on the social issue that the organization is trying to tackle. It depends on the way that they are tackling it. And that assessment will help you to understand whether it should be a grant funded activity or whether it might be appropriate through a social investment. One distinction that I would like to draw as well is that very simplistically, in social enterprise, you tend to see what are called either cross-subsidy models, where you have a part of the organization that is generating profit, and then that profit is being used to deliver charitable activity. And then you have another form of social enterprise where it's either called lockstep or it's called mission aligned, where the activity that is generating your revenue is also generating your impact. Personally speaking, I don't really think that there's a huge amount of efficiency in the cross-subsidy model. I think you could probably look to Hauke's philosophies there and just invest in something that yields a high return and grant fund the activity that needs to be grant funded. Why create a bolt-on business that generates some surplus that ultimately you can then give a little bit of to deliver some social impact? However, there are some social enterprise models out there where they are delivering their social impact alongside a self-sufficient revenue generating activity. And I think those are the really exciting social enterprises that you can invest in.
Great. Joanne? No? Okay. So another question, which will go to Joanne because it's about Venturesome. So this person has said that they think there's something like 100,000 or potentially over 100,000 social enterprises in the UK right now, and that research into the needs of these enterprises is that apparently they're requesting kind of funding of below the £250,000 level. That's patient capital plus support like mentoring and training, access to networks, etc. Now, I think we can safely say this is the kind of organizations that Venturesome invests in, but are there sort of services that you're looking maybe to provide above and beyond that, resources, things like that, for potential investee companies you decide not to go with, but still want to support in some way?
We, of course, always want to support our investee organisations with more than just finance. And we will look to, as I said, improve their governance or financial controls any way that we can. If we do look at them and they decide that social investment isn't for them, or we decide that we're unable to offer them the finance, we will then refer them to something called the Reach Fund. Now, the Reach Fund offers grants, and that helps organisations become the term that is used a lot, investment ready. So that will offer consulting to them. We're looking all the time at how we can improve our products, and we know that there's a demand for more patient capital at lower interest rates, and that's just something that we hope that we can look to evolve in the future.
Great, thank you. A question here about kind of shifts in culture. So we talked obviously quite a lot at the beginning about this question of impact washing, huge sums of money coming into the sector, perhaps not being used all that effectively. What do you think? So what is EVPA doing, for example? What is Venturesome doing? What would you find useful as a potential impact investor, Edmund, to kind of change the culture in the world of impact investment towards something that's kind of genuinely useful and perhaps, going back to Hauke's points, fills real needs rather than sort of a checklist approach? Do you want to go first, Alice?
Yeah, so one other initiative that I wanted to mention earlier is a global initiative called the Impact Management Project, which we can also circulate details of later. And this, again, is a response to the risks of impact washing. It's trying to create some consensus. At the moment, you have had almost every impact investor or impact fund that is out there has their own impact framework and their own way of reporting on impact, which isn't very helpful if you're an investor trying to decide between them, and also kind of goes against the points I was making earlier about kind of transparency and rigor. So the Impact Management Project is a very well considered program that is trying to bring some consistency to the way that people report on their impact. So I think that's an encouraging tailwind in terms of changing the culture. I think also what has happened perhaps over the last 3 or 4 years is that what was once quite a niche kind of social venture, social impact investing community has been very proactive at trying to engage the mainstream. And this is one of the reasons why you've seen a hell of a lot of, private equity funds are raising their own impact funds. And you're also seeing, mainstream asset managers and pension funds looking to shift towards impact. So I think that we are seeing those who hold capital now more proactively asking questions about impact, which is a really encouraging kind of cultural shift. And finally, if I might add, I feel like that hopefully means that one day we don't have socially neutral investors. So in terms of the market efficiency point, there isn't anyone else who's going to snap up a tobacco company share because nobody's willing to do that anymore.
I know, Joanne, Venturesome's obviously been in this sector for a while. What have you seen in terms of cultural shifts?
In terms of cultural shifts, it's hard for me to comment on that.
Right.
As there are other people who have been here longer than I have.
Fair enough.
But I would just say that on the impact management project, that's something we would welcome because we do have our own impact measurement framework. But again, it's very subjective.
Right.
It's really hard to compare one organisation that's generating jobs or one organisation that is supplying broadband to the rural north. You're comparing oranges with apples, and how do you do that? You don't. So it really is something that's still very, very subjective. So we would welcome that.
Okay.
But, yeah.
Great. Edmund, we have a question for you here, which I think is also a very interesting one. Sort of as both potentially a donor making charitable donations and also an impact investor, what do you think, if you could answer it, gives you more satisfaction? Or do you enjoy doing more?
Very difficult question indeed. I think, and it sort of gets very sort of close to your personal values and motives about why you do what you do. I think as was said on my biography, I mean, my Christian values are important to me, and that drives, and that means I give. It also means that I have to be, I try and be beneficial, especially now I can afford to be, with what I invest. But it's very difficult to know because because I won't really know what good it either does to individual people.
Right.
So it's a very difficult one. I can't really answer it.
Yeah, fair enough. I suppose you're taking a leap of faith. But on that note, which I think is a good one to end on, I'd like to thank everyone for joining us today and to thank our speakers.